Imagine you're applying for a multi-million-dollar commercial loan.
Right.
You submit just this mountain of complex paperwork. And then exactly 3 minutes later, 3 minutes, you are fully approved.
Sounds impossible, honestly.
Yeah, but you're not approved by a human banker in a suit. It's done by this highly coordinated team of specialized artificial intelligences.
Yeah.
They've already analyzed your financial history, priced out your specific risk, and literally argued with each other about whether you are a safe bet.
And I mean, the crazy thing is that scenario isn't science fiction anymore. It's not just some futuristic vendor pitch. We're actually watching the absolute rewiring of global financial services right now.
It's wild. So welcome to today's deep dive. We've got a massive stack of sources today. We're looking at everything from AI architectural diagrams to these super urgent regulatory roadmaps.
Yeah, and they all point to this one massive crisis, or, well, tension, right? Institutions are desperately trying to survive what the industry is calling the dual mandate.
The dual mandate.
Right. Exactly. On one side, banks and insurers have this relentless market pressure for exponential efficiency. They have to be faster. But on the other side, they are just slamming into this wall of absolute compliance from global regulators.
Because regulators are terrified of autonomous machines just, running the entire economy.
Exactly. Completely terrified.
So our mission today is to pull apart that dual mandate. We're going to explore how the financial sector is magically shrinking its decision-making pipeline from days down to literally minutes.
While also dodging a rapidly approaching legal minefield.
Right. And, why should you care about this? Well, whether you're applying for a mortgage, buying business insurance, or just, having your credit card decline while trying to buy a coffee.
Yeah, the worst.
Right. These invisible AI agents are now the ones making the call. It affects all of us.
And the overarching takeaway from all the data we looked at is actually kind of counterintuitive.
Why so?
Well, the ultimate winner in this financial arms race, it won't actually be the institution with the fastest, most powerful AI.
Oh, really?
No. The winner is going to be the institution that can perfectly audit and explain its AI's decisions to a government regulator in real time.
Okay. The explainability piece. We're definitely going to get into that. But to really grasp how revolutionary this new system is, I think we first have to look at the agonizing bottleneck of the old world, right?
Oh, absolutely. The traditional manual pipeline.
Yeah, we have to understand the pain of that old process.
The industry actually refers to that old pipeline as the time tax.
The time tax.
Yeah. Historically, underwriting a commercial loan or an insurance policy, it operated like a rusted manual assembly line.
Right. Just painfully slow.
Exactly. A broker emails a massive submission package. We are talking dozens of messy PDFs, handwritten medical questionnaires, really dense financial reports.
Just a nightmare to sort through.
And a human underwriter then has to manually open every single file. They visually scan for the data, extract it into a separate spreadsheet, check it against massive internal policy binders.
Oh my gosh.
And then send emails back and forth for days just trying to track down missing signatures.
And the sources put some brutal numbers on that time tax, too. For a standard policy cycle, the average decision time was 3 to 5 days.
Yeah.
Think about sitting in limbo for almost a work week, just waiting for an initial quote. And the actual active human work required for that single case. Roughly 120 minutes of intense manual data entry.
Which directly translates to a massive, totally unsustainable cost burden. The benchmark processing cost for a standard 14-day commercial policy cycle was estimated at $800.
$800 per cycle.
Right. And out of that $800, $60 to $75 was purely the cost of human labor. Just paying standard underwriter hourly rates.
Well, and humans also get tired, right? Especially when they're staring at complex spreadsheets at 4 in the afternoon on a Friday.
Oh, for sure. And that fatigue leads to what the insurance industry calls premium leakage.
Premium leakage.
Yeah. You have these overloaded human underwriters trying to rush through complex documents just to hit their quotas. And they inevitably miss critical details. They miscalculate risk exposures.
Right.
And this isn't just a minor hiccup. The projections for U.S. insurers in 2026 showed a deteriorating combined ratio hitting around 99%.
Okay, wait, let's break that term down for a second for everyone.
Yeah.
A combined ratio hitting 99% essentially means that for every single dollar the insurance company took in through premiums, they were spending 99 cents on paying out claims and covering their own operational expenses.
That's right.
They were barely breaking even.
And barely keeping the lights on because the manual process was incredibly porous. But this brings us to the technological leap.
Right, the fun part.
The sources highlight this highly specific case study from Hiscox in the London market. It focuses on complex specialty insurance lines, and they implemented a system known as Agentic AI.
Agentic AI.
Yeah.
Okay.
Yeah. And the results. They completely upended the industry standard. Their quote to bind cycle, meaning, the time it takes from a broker requesting a price to the final legal contract being locked in, it was slashed by 99.4%.
That's
It
insane.
went from a 3-day waiting period to exactly 3 minutes.
3 days to 3 minutes, and the total active underwriter time plummeted from 2 hours of manual labor down to just like 5 to 10 minutes of final review.
Exactly.
The architectural diagrams in our sources explain how they actually achieved this, and it centers around an agentic hub, which, honestly, I'm looking at this structure like a highly efficient commercial restaurant kitchen.
I like that analogy.
Right, because you don't just have one chef trying to chop the onions, cook the steak, and plate the food all at once. If a single language model tries to do all of that, it just collapses.
Right. It hallucinates or breaks down. You need specialized parallel processing. In this AI hub, you have distinct digital workers handling different tasks simultaneously.
Okay, break that down for us.
So you start with the submission triage agent. Using your restaurant analogy, that's your prep cook.
Got it.
It instantly scores incoming emails, categorizes the risk, and just throws out unqualified leads before they even enter the main pipeline.
That saves so much time alone.
Exactly. Then you have the Intelligent Document Processing Agent, or IDP. This is a specialist trained entirely on pulling structured data out of messy, unstructured PDFs,
Yeah.
and it boasts an accuracy rate of over 99%.
Over 99%. And while that's happening, you've got the proactive chasing agent acting as the expediter, right?
Yes.
Like if the IDP notices a signature is missing on page 4, the chasing agent automatically drafts and sends an email back to the broker to get it. A human doesn't even have to ask it to do that.
Yeah, it's completely autonomous. And finally, you have the Decision Support Agent, the sous chef, who aggregates all this perfectly clean data and outputs a comprehensive quote.
Okay, but my favorite part, the most fascinating element of this entire architecture, is the inclusion of the critic or the adversarial review agent.
Oh, yeah, that's a game changer.
It's literally a completely separate layer of AI, and its sole programmed purpose is to argue with the decision support agent.
It's so brilliant.
Before any quote is finalized, the critic deliberately searches for contradictions or logic flaws or math errors in the initial recommendation. Now, our sources note that running this adversarial review adds about 33% more processing time to the cycle.
Right, which sounds like a lot, but
But when your entire cycle is only 3 minutes long, adding 33% just means you're waiting an extra, 60 seconds?
exactly. And that 60-second investment pays massive dividends. That adversarial back and forth drastically reduces AI hallucinations. It serves as an automated, super rigorous quality control checkpoint before a human underwriter ever even looks at the screen.
Okay, so we've gone from days to minutes. But when you shrink processing times that dramatically, you aren't just saving an underwriter a few hours of reading PDFs, you are fundamentally altering the economics of the business.
Oh, entirely.
Let's look at the actual return on investment of this hyperspeed.
So in commercial property and casualty insurance, which covers businesses for things like liability and property damage, there's this unwritten rule: the first quoter wins.
First quoter wins. Makes sense.
Yeah. Brokers are under so much pressure from their clients, so they actively look to bind the first acceptable quote they receive. If one institution takes 3 days to manually process a submission, and another institution uses an agentic hub to return a fully priced quote in 3 minutes.
The 3-minute response completely obliterates the competition.
Obliterates it. SMED becomes the primary driver of sales conversion, and the financial markets are clearly rewarding this capability. We looked at McKinsey data in our stack, and it reveals that insurance AI leaders are currently generating 6.1 times greater shareholder return compared to their legacy peers.
6.1 times. Wow.
They are achieving what the reports classify as nonlinear scaling.
Okay, nonlinear scaling. Let's dig into that because it's a massive competitive advantage. It means these institutions are seeing a 40% increase in total quote capacity without adding a single human to their underwriting headcount.
None. 0 new hires.
They're processing vastly more volume with the exact same team. And on top of that, because the Agentic Hub is so thorough at checking historical data and identifying hidden risks, these early adopters are actually improving their loss ratios by 3 to 5 percentage points.
Yeah, the data is undeniable.
Wait, I have to push back on this narrative a bit, though. Aren't we just automating bad decisions faster?
Well,
I mean, if an AI is blindly approving commercial risks at light speed, isn't that just a recipe for a catastrophic financial bubble? Because I'm looking at some of these vendor marketing claims in our sources promising 140% sales growth overnight. It sounds suspiciously like a hype machine.
it's a totally fair question.
Yeah.
And the sources actually provide a vital reality check on those exact vendor claims. Direct marketing promises of 140% immediate sales growth. Those are largely unverified myths.
Okay, good to know.
Yeah, the true return on investment isn't some magical overnight spike in sales from blind AI approvals. The real financial ROI lies in zero abandonment rates.
Because it's so fast.
Right, because the process takes 3 minutes, customers don't get frustrated by the wait and walk away to a competitor. And it also allows for dynamic, real-time tariff personalization.
Meaning the customer gets a price tailored exactly to their real-time risk profile rather than being, dumped into some generic pricing bucket just because a human didn't have time to look at the nuances.
Precisely. And regarding your point about the danger of automating bad decisions, the architecture actually prevents this through a mechanism called the verified knowledge layer.
Ah, okay.
This agentic hub is not just some open chatbot surfing the internet for answers. It is strictly tethered to the institution's proprietary, heavily approved internal risk guidelines. Because of that hard-coded grounding, error rates and hallucinations drop to roughly 5%.
Oh, wow.
Yeah, the AI actually enforces strict underwriting consistency far better than a human worker can.
Okay, so we solved the speed problem, but operating at hyperspeed introduces a terrifying new vulnerability.
It does.
Right, because if you are approving a loan or binding a policy in 3 minutes, you no longer have the luxury of time to manually verify if the person on the other end of the screen is actually who they say they are.
Exactly.
Which brings us to the second half of this AI equation, security. The same pattern recognition that's transforming sales is completely changing how banks catch criminals.
And this is the point where artificial intelligence directly touches the daily life of every single consumer.
Yeah. Think about the last time you were on vacation. You land in a new time zone, you try to buy a coffee or maybe a train ticket, and your credit card gets aggressively declined. It is an infuriating experience.
It's the worst. And it happens because banks historically relied on rigid, rule-based systems. They program these hard mathematical thresholds into their security protocols.
Like what?
For example, if a transaction exceeds $5,000 and the IP address originates in a foreign country boom, the system automatically triggers a hard block.
Right. And those legacy rule-based systems had a baseline fraud detection rate of roughly 76%. But their fatal flaw was just an unsuitably high false positive rate.
Way too high.
A false positive being when the bank aggressively blocks a completely legitimate transaction made by a real customer, like you trying to buy that coffee.
And the true cost of those false positives is staggering.
Yeah.
It is much more than just a failed $5 payment. It triggers immediate customer churn.
Oh, absolutely.
A client gets embarrassed at a busy checkout counter, they put your card at the back of their wallet, and they pull out a competitor's card. It causes lasting reputational damage. It also creates a massive operational drag because that frustrated customer immediately calls your support center, forcing you to pay a human agent to resolve a mistake the computer made.
This is exactly why the financial sector is abandoning those old rules and shifting to large transaction models, or LTMs.
Yes, LTM.
We need to explain how these actually work because it's brilliant. So think of a large language model, right? It predicts the next logical word in a sentence. Well, an LTM predicts the legitimacy of a financial transaction by constructing massive, multidimensional network graphs in real time.
Yeah, instead of looking at a single swipe of a credit card in isolation, an LTM builds this web of interconnected nodes. One node is your current IP address. Another node is the unique hardware ID of your smartphone. Another represents your historical purchase velocity over the last 5 years.
It's taking in everything.
Everything. The LTM maps all these variables and looks for mathematical anomalies in the actual shape of that graph. Hybrid AI systems utilizing these LTMs have pushed overall fraud detection rates up to an incredible 92 to 95%.
While simultaneously bringing the false positive rate down to a best-in-class benchmark of around 3%.
It's amazing.
The sources detail this really specific context-aware example from MasterCard that shows how this network graph functions in practice. So imagine a client whose historical graph shows they typically only buy mid-market clothing. Suddenly, there's a massive flurry of luxury goods purchases on their card.
Now, under the old rule-based system, that sudden deviation in spending behavior triggers an automatic, unavoidable block.
But the LTM doesn't just look at the expensive price tag, it looks at the surrounding context of the graph. It checks the seasonal timing, like, is it late November, meaning these are likely holiday gifts? It checks the merchant credibility. It cross-references geolocational fingerprinting. And this is the part that feels like absolute science fiction. It actively checks behavioral biometrics.
Yeah, that part is wild.
Behavioral biometrics, can you explain that?
So behavioral biometrics means the system is literally analyzing your physical interactions with your device.
Yeah.
It measures your specific typing cadence. It calculates how fast you are inputting information into the checkout fields. It even analyzes the gyroscopic data from your smartphone to determine the exact angle at which you typically hold your device.
Wait, the LTM knows it's you because you type like you? It knows you hold your phone with like a slight leftward tilt?
Yep.
And if all those microscopic contextual markers align perfectly with your historical graph, the LTM overrides the spending deviation and approves the transaction.
Exactly.
And the entire complex mathematical verification is completely invisible to you at the checkout counter.
It's totally seamless. And, the transition to LTMs isn't just a luxury for customer service. It is a defensive necessity. Because criminal syndicates aren't using rule-based systems anymore either.
Right. They're upgrading too.
The weaponization of generative AI by bad actors is escalating rapidly. Currently, 92% of financial professionals report detecting fraudsters utilizing sophisticated Gen AI tools. We are talking about deepfake video manipulation, synthetic voices attempting to bypass voice authentication at call centers, and automated reconnaissance scripts.
So banks are essentially forced to deploy behavioral biometrics and LTMs just to keep pace with the AI being used against them.
Yeah.
And the defensive strategy is working. 83% of financial institutions report significant drops in falsely blocking legitimate transactions, all because they finally have systems that understand human context.
And this is massive, but all of this autonomous speed, these hyper-efficient agentic hubs, and these network graphs monitoring our typing cadence, they have terrified global governments.
They really have.
The bullet train's moving way too fast, and regulators are actively stepping onto the tracks.
Which brings us to the massive, concrete legal wall dead ahead. Let's ground our timeline here. It is currently April 2026, the absolute non-negotiable deadline for the European Union AI Act's full compliance for high-risk systems, what the legislation calls Annex 3 systems, is August 2, 2026.
Just a few months away.
We are literally just months away from a regulatory bottleneck that could shut these systems down completely.
And it is critical to define what the EU classifies as an Annex 3 high-risk system, because it covers almost every transformative technology we just discussed.
Right.
Individual credit scoring algorithms, high risk, life and health insurance pricing models for individuals, high risk, anti-money laundering individual profiling, and any know your customer systems utilizing those behavioral biometrics, all categorized as high risk.
The entire engine of modern banking is right in the crosshairs. Though interestingly, standard client service chatbots are only marked as limited risk.
Which makes sense.
Right. It makes logical sense since a chatbot isn't deciding if you get a mortgage. But for the core decision-making AI, the hammer is coming down. And the legal friction centers primarily around the German regulators, BaFin and BSI, and their strict baseline of explainability. Customers and governments inherently distrust black box AI.
And BaFin's regulatory principles are uncompromising.
Yeah.
They demand that complex AI systems must be able to auditably explain exactly why a transaction was blocked or why a life insurance policy was priced higher for a specific individual. You cannot simply tell a government auditor, well, the LTM flagged an anomaly in the network graph.
They won't accept that.
No.
Which highlights the core tension in the sources, the explainability gap. There is a deep structural irony here. As artificial intelligence becomes more sophisticated and better at its job, like an LTM mapping millions of invisible data points, typing speeds, and geolocations to catch fraud, it inherently becomes harder for a human brain to comprehend.
Exactly.
How is a human fraud analyst supposed to audibly explain the mathematical logic of gyroscopic phone tilt analysis to a government regulator?
It is a massive headache for executive boards right now. And it gets even more complicated with Article 14 of the AI Act, which mandates human oversight.
The emergency brake.
Right. The law explicitly states that AI cannot be fully autonomous in these high-risk areas. A human underwriter must always retain the power to override the AI's recommendation. They have to intervene for edge case validation, make adjustments for potential algorithmic bias, and ultimately take total control over the final pricing on complex risks.
Wait, so banks essentially have to freeze their incredibly fast AI, open up the digital hood, and mechanically prove to the European government that they have installed an emergency brake
Yes.
by August.
That is the exact scenario keeping compliance officers awake at night. Our sources lay out the rigorous 2026 action plan checklist that every financial institution is frantically scrambling to finish. First, they must conduct a comprehensive enterprise-wide AI inventory.
Okay.
They have to map every single large language model, LTM, and Agentic hub active across all business units.
Then they have to formally map those systems against Annex 3 to document the precise risk classification. They have to establish rigorous data governance protocols, which involves, auditing their historical training data sets specifically to prove they are actively controlling for bias in their scoring models.
And crucially, they have to physically hard code the human oversight mechanisms. They must mathematically and mechanically verify that their human underwriters and fraud analysts possess a documented functional override switch to satisfy Article 14.
And finally, they must complete independent third-party conformity assessments to acquire their official CE marking and register their AI in the public EU database.
That's a lot.
All of this must be completed before August 2nd. If they fail, the fines are catastrophic, ranging into the tens of millions of euros, and the non-compliant AI systems have to be legally powered down.
The dual mandate is the absolute reality of 2026. Exponential efficiency is no longer an optional luxury for financial institutions, but absolute regulatory compliance is the only way they are allowed to keep their doors open.
Well, we have covered a massive amount of ground today. We explored how the specialized digital workers within an Agentic hub shrunk the agonizing underwriting pipeline from 3 days down to just 3 minutes. We broke down how large transaction models construct network graphs to save us from false fraud alerts by quietly analyzing the context of our lives right down to our typing cadence.
Yeah, that's still wild to me.
And we unpacked how the impending August deadline of the EU AI Act is forcing these financial giants into a frantic scramble to prove they are still the masters of their own machines.
It's a race against time.
Which leaves a really lingering thought based on the tension between these massive AI systems and the law. We discussed Article 14, right? The strict mandate for human oversight. The legislation requires that a human must always have the power to override the AI. But consider the long-term implications. If human underwriters are now relying on an Agentic hub to process 99.4% of the data because the sheer volume and speed are simply too vast for a human brain to handle anymore, do humans eventually lose the intuition required to actually know when to pull that manual emergency brake?
Oh, wow.
Will the human oversight mandated by law eventually degrade into just a tired human merely rubber stamping an AI's complex decision that they can no longer fully comprehend? It is a fascinating evolution of the systems that govern our money. Keep questioning the invisible architecture around you, and thanks for joining us on this deep dive.